Welcome to this explainer. You know, we constantly hear about massive national budgets, but we're going to unpack the real story today. We're diving into exactly how high-level fiscal policy collides with on-the-ground banking realities. We're taking the fiscal year 2026-27 budget and putting it side by side with a comprehensive credit risk analysis. Because ultimately, we want to see how the financial sector is quietly bracing for the year ahead and how those astronomical numbers actually dictate who gets funding and who doesn't.
I mean, it really is the ultimate financial question, isn't it? How does a whopping 17.1 trillion rupee national budget actually dictate whether a local factory or a tech startup gets a loan? To find out, we're putting these two very different financial lenses together to understand exactly what risk managers are seeing that politicians might be glossing over.
All right, here's our game plan for today. We're going to look at the two economic lenses, compare macro growth to micro risk, weigh households against corporate borrowers, spot the sector winners and losers, and wrap it all up with the banking strategy playbook. Let's get into it.
Starting off with Section 1, the two economic lenses, macro versus micro.
Okay, so think of the budget overview as, well, a macro telescope. It's looking way out at the broad horizon, fiscal goals, IMF compliance, and projecting general investor confidence. But the credit risk analysis, that's your microscope. It zooms right past all the big political rhetoric and focuses intensely on borrower leverage, tightening liquidity conditions, and hidden portfolio risks. You absolutely need the telescope to know where the economy is going, but banks rely on the microscope to ensure they don't lose capital along the way.
So, what exactly is the credit risk and sector lending analysis? Well, it's a framework that actually builds on those massive national budget figures. It's not contradicting the budget at all. Instead, it takes those broad macroeconomic assumptions and translates them into actionable banking, credit, and portfolio implications. It is literally the practical filter that commercial bankers use to underwrite loans in the real world.
Moving right along to Section 2, macro growth versus micro risk. Let's look at the hard numbers.
Think about where these two documents perfectly align and where they totally part ways. Both are completely consistent on the sheer size of the pie, yep, that's 17.1 trillion rupee budget, and both bake in an 8.4% inflation rate. But when it comes to forecasting actual economic expansion, the budget projects a pretty optimistic 4.1% GDP growth, while the credit analysis, it's way more conservative, bringing in a divergent range that starts at just 3.5%.
And honestly, that 3.5% is absolutely crucial. The credit analysis grabs onto this lower growth rate to act as an IMF reality check. Because let's face it, when you are managing billions in loan portfolios, blind optimism is a massive liability. Risk managers are explicitly using this tighter growth margin to stress test whether a business can actually survive a slower, constrained economy.
Then, we have to talk about the 11.5% State Bank of Pakistan policy rate. While the budget just kind of talks about general inflation outlooks, the credit perspective drags this specific rate right into the spotlight, even factoring in a likely rate increase by April 2026. For commercial banks, this literally dictates the true cost of borrowing and immediately impacts any company's ability to service its debt.
All right, Section 3, households versus corporate borrowers. It really is a tale of two borrowers.
The divide between these two documents is just stark. The national budget is heavily focused on the salaried class. We're talking 7 to 10% salary and pension increases, plus cost of living relief. Basically, a very household, voter-centric view. But the credit analysis? It is locked dead onto corporate borrowers. It's looking at deep working capital pressures, corporate profitability, and spiraling energy costs. The banking sector is clearly hyper-focused on the intense cash flow pressures facing businesses right now.
So, just how intense are those pressures? Well, the credit paper goes a massive step further than the budget by quantifying the exact fiscal choke points. It factors in the direct hit of 430 billion rupees in new tax measures, plus the sheer burden of a 1.727 trillion rupee petroleum levy. That is huge. Add in deepening working capital shortages, wild FX volatility, and stricter tax compliance risks, and yeah, you can see why bankers are scrutinizing corporate cash flows. Businesses are being squeezed really tight.
Which brings us to Section 4, sector winners and losers. Let's break down the industry impacts.
Starting off with power and energy. The national budget makes broad notes about tariff reforms, but the credit analysis, it immediately throws up major red flags over circular debt concerns, IPP financing risks, and heavy fuel import financing needs. The practical takeaway for banks here is strict conditionality. Lending to this sector now heavily requires specialized escrow-backed structures just to mitigate those circular debt risks.
We also see this incredibly stark contrast between the IT and manufacturing sectors. The credit document actually points out the IT sector as a structural growth winner with low to medium funded risk. That's a brilliant insight the budget barely even touches on. On the flip side, heavy manufacturing is flagged as highly vulnerable. It's dealing with high demand sensitivity, massive exposure to that 11.5% interest rate, and serious import dependence.
Even when we look at agriculture, a sector where the budget is a bit light on details, the credit analysis totally fills in the blanks. It pushes for deep seasonality analysis and models for severe weather risks. Basically, to lend safely here, banks have to pivot to specialized mechanisms like warehouse receipt financing, and they absolutely need crop-backed structures to secure capital.
And listen, banks aren't just guessing at these vulnerabilities. They actively simulate them. The credit analysis explicitly instructs risk managers to run their portfolios through 3 very rigorous stress testing scenarios. They have to model an 8 to 10% inflation environment, simulate sudden energy price shocks, and calculate the exact impact of severe tax burden shocks. If a company's cash flow can survive those 3 hits, well then it might just be worthy of a loan. Finally, Section 5, the Banking Strategy Playbook. Let's see how this all comes together. So the source material ultimately distills all these incredibly complex macro assumptions into a highly actionable 3-tiered traffic light credit allocation system for FY 2026-27. This is literally the exact framework credit committees are using to approve or deny loans right now. Let's break down these lights.
First up, we have the green light. This is where banks are told to actively increase their focus and aggressively deploy capital. The clear winners here are exporters, trade finance operations, the booming IT sector, and any borrowers backed by SBP refinance schemes. These represent your lower-risk, high-yield areas that align perfectly with structural growth.
Next is the yellow light. This one mandates selective exposure only. We're talking about industries like textiles, renewables, and essential manufacturing. For textiles, banks are told to look incredibly closely at working capital intensity and export letter of credit comfort. It's not a hard no, but it definitely means extreme caution and careful scrutiny of daily cash requirements before any funds are released. And finally, the crucial red light. Risk managers are explicitly warned to avoid exposure to these groups. Who's in the red zone? Weak sugar companies, highly leveraged manufacturers, and businesses that are heavily dependent on government subsidies. In a tight fiscal budget, those subsidies can just vanish overnight. And with an 11.5% policy rate, highly leveraged companies can literally be crushed. If your business falls in this bucket, securing bank financing is going to be incredibly tough.
When assessing the overall scoring from our source material, the difference is just glaring. On a scale of practical utility for credit decisioning, the broad macro budget overview scores a 3 out of 5, but the credit risk analysis, that scores a perfect 5 out of 5. The budget gives us the big picture backdrop, sure, but the credit analysis is the actual survival roadmap for profitability.
Which leaves us with a really critical thought to ponder as we wrap up this explainer. As fiscal policies tighten up and the economic landscape gets tougher, ask yourself, are your commercial lending decisions relying purely on the macro telescope, or are they firmly anchored in the microscopic, hard-hitting realities of credit risk? Because knowing the difference between those two lenses is exactly what separates a theoretical, nice-sounding budget from a stress-tested, profitable reality. Thanks so much for joining me on this deep dive. Keep learning, stay focused, and I'll catch you in the next explainer.